The market is currently pricing in a Fed rate cut on September 18th. We anticipate a 25 basis point cut. With inflation closing in on the Fed's 2% target and the labor market is still healthy, the start of the rate cutting cycle will likely be good news for the U.S. economy. Now, rate cuts may pose challenges to liquidity-minded investors, but there are ways to potentially mitigate the effect of declining yields on one's cash reserves. Let's take a closer look. In recent years, with money market yields elevated and the yield curve inverted, the perceived cost of holding excess liquidity may have seemed relatively low. If economic conditions evolve broadly as we anticipate, however, shorter-term yields will likely fall significantly and the curve will likely disinvert. So now would be a good time for investors to reassess the size and composition of their cash reserves. Let's look first at the composition of cash reserves. Direct holdings of money market instruments, such as T-bills, that are not sufficiently diversified across the maturity spectrum may be subject to an abrupt decline in yields when the Fed begins cutting rates. In contrast, a well-diversified money market fund that is invested in a wide range of maturities may help ease the sting of declining yields. History suggests that when the Fed starts cutting rates, investors potentially benefit from moving a portion of their cash not already earmarked for short-term or operational needs to ultra-short fixed-income strategies. These strategies add only limited exposure to interest rate risk because they typically focus on bonds maturing in 3 years or less, and they potentially generate favorable risk-adjusted returns by including holdings of high-quality short-term corporate bonds and asset-backed securities. One last point before we close. While we agree with the market on the timing of the first rate cut, we believe economic conditions may warrant a more gradual pace of rate cuts than currently priced in. For instance, unlike the market, we view the bar for a 50 basis point cut this month as very high. More generally, the effects of cuts on the front end of the curve may not be as pronounced as the market currently anticipates. But this is a topic for another day.